Welcome to lecture 25, where we're going to talk about probability mutation. And so this refers to what happens to the probability of our trade becoming a winner or a loser as we move our stops and targets. So to illustrate this concept, we're going to start off with running a random entry exercise. And you can do this on your own. So all you need to do is pick your favorite market, say SPX, Euro, bonds, it doesn't really matter, and just place random paper trades with different risk-reward ratios on the bracket. So for example, you just go randomly long ES, and maybe if you want to test the 1-to-1, you're going to put a stop 10 points below, and then you're going to have a target 10 points above. And then you're just going to run this over and over again. And what you're going to find is after a string of trades, it's going to be around a 50% win rate because the risk or the reward to risk ratio is 1-to-1. Now, if you run this with a 1-to-2 reward to risk, so say we had a E-mini S&P random entry with a 20-point stop and a 10-point target, that's going to generate roughly a 66% win rate. And so this is really going to show us how efficient the markets are. So tweaking this reward to risk ratio will give us a win rate that's very, very close to break even because we're using random entries. So for example, the target, a same distance as stop, is going to produce a 50% win rate. So if you just have no edge to your entry, you just enter the market at random and you place your target, say 5% above the current price and your stop 5% below, that system's going to win roughly 50% of the time, even with a random entry. Now, if we change that where the target is twice the distance of the stop, that's going to produce a 33% win rate. So let's say we entered, we put a 5% stop below it and a 10% stop above it, and we did a bunch of sequencing of trades, that's going to win about 33%. Now, if we took it even further and said did a 3x, so a 5% stop with a 15% target, you're going to see that create around a 25% win rate. And then if we took the stop and we inverted the reward to risk and instead we did a 10% stop on a 5% target, you will actually see this completely random system win about 66% of the time. And that's because the target is closer to the entry than the stop. And running this system is a really good exercise to see just how efficient the markets are if you're not applying any type of analytical edge. You can create 66% wins just by moving a target closer to the entry than the stop is. So I've actually run a back test, using completely random entries to illustrate this concept that the close profit target and far stop can create win rates way in excess of 50%. So in this particular study, I entered the market at random, long or short on the ES, and took profits when the candle close was around 20 points in our favor, and then took a loss when the candle close was around 100 points against us. So this would be risking 5 to make 1. And here are the results for one iteration. So this was on 60-minute bars. And you can see here the win rate was 79.3%. And so keep in mind, this is a system with completely random entries, absolutely no edge, no analytical technique, and it's still winning 80% of the time. And that's because our winners are smaller than our losers. We're taking profits much quicker. And you can see that here, average winner 6,600 versus average loser of 23,900. And here's another completely random test ran on the 180-minute time frame instead. And this was a little bit of a lower win rate just out of chance, but it still was well above 50%. We had 76% winners on this system that literally just chose at random whether to go long or short. So you can see here how having a profit target very close to your entry compared to your stop, let's say your stop's down here, is going to create a high win rate regardless of the edge. So the takeaways from this is that the system win rate depends much more on the stop distance in relation to the target than it does to the actual edge. So what's going to happen is the edge will tweak the break-even win rates slightly. So say we have a 1-to-1 stop to target ratio. We expect on a break-even system for that to win about 50% of the time. And then if we apply an edge to the market, say we win 55% of the time, or maybe even 60% of the time. That's what the edge does. But the actual, the ballpark of the win rate on the system is much more dependent on how you structure the reward to risk. So in general, tighter stops with larger reward to risk, you're going to have higher leverage on your trades, which means larger winners. But then you're also going to have more stop outs, right? Because your stop is much closer than your target, hence the larger reward to risk. And then if you're taking wider stops with smaller reward to risk, you're going to have less stop outs. You're less prone to shocks and stop runs. But then you're going to have smaller leverage and smaller winners because your stop is far away compared to your target. So you're giving your trade a lot more room. But because the stop is so far away, you're going to have smaller size on. So when that trade does win, it's going to be a smaller winner in your book. So let's look at this example on T-bond futures. And I have a pretty tight stop here. And you can see the risk reward ratio is 5. So we're risking 1 to make 5 on this particular trade if our target was up here. But if we extend that stop, if we widen that stop, so same entry, the market did the same thing, but we allowed more room for the trade to work itself out, that risk reward ratio plummeted to 2.62. So in this scenario, we would expect to stay in the trade for a little bit longer, right? We could handle more noise if the market were to come back down and chop around and then eventually make its move. But we're not going to make as nice of a winner if it does run for us. Whereas this one, we have that tighter stop, so we're giving it less time for it to kind of work its way through, and we actually risk a stop out if it just goes halfway down into the consolidation zone. But if we do win, we're going to win 5 times the risk instead of this one, which was 2.62. So the next thing I want to talk about is this paradox of winners. So people always talk about how it's good practice to press winners, and we completely agree with that for the most part. But at the same time, it's important to remember that the further price moves in the correct direction, the worse the reward to risk actually becomes. And so, for example, say you had a trade that already earned a 4R, so it's earned 4x the initial risk. Let's say the initial risk was 10,000 and you're already up 40,000 on the trade. And you're looking for a potential 6R move, so you're looking for 2R more or 60,000 in total. You only have 2R of upside compared to 5R of downside if you let the trade run all the way down to your original risk point. So if a trade's nearing your target, it becomes difficult because you have actually a lot more to lose than you have to gain at that particular moment in time. Because as a trade runs for you, as if say you have here's your entry, here's your stop, and here's your target. As this trade runs for you, it becomes a larger distance away from the stop than to the target. So your asymmetry actually disappears as the trade goes for your direction. So it's a difficult balancing act when you're trying to decide whether or not to take the winner or continue to let it run. But generally, we want to aggressively exit and trail when trades complete a majority of their moves. So it's good practice that when a trade is reaching your target, especially if it's a high R, like a 4R, 5R, 6R, you want to get really aggressive on the trail and the profit taking because you actually have asymmetry to the other side. So you can lose more in the trade than what you can gain in the trade at that point. So if you have a huge winner, be mindful of being extremely aggressive on your trail stops. So what we typically do at Macro Ops, how we manage our trades, is we take the first exit at the implied target of the pattern, usually half the size off. And then the second exit, we try to trail and run as far as we can. And there's also discretionary overlay at play here as this mechanical profit-taking system plays out. So the reason why we take a little bit off the implied target is because you reduce that equity curve volatility. So if you have something that runs up at the target and then comes back down for a huge drawdown before making its next run, taking a little bit off, taking half off at that target will definitely reduce the drawdown in your portfolio when it pulls back. So if you're going to be someone that enters trades and tries to run them for as far as you can with trail stops the whole way, then you're going to have to take the drawdowns on the way. So for example, if this one hit the profit target and you didn't take anything off, you would have to give back, maybe around 50% of your profits in the trade right there before it goes on the next leg. So it's a little bit easier from an emotional standpoint to handle the two tranche system with one at the target and then the next at the trail stop. But it comes down to really what you like to do and how you like to trade. It's a very personal decision. So I got NQ futures pulled up here just to show you guys how we would think about this. So let's say we were trading this particular consolidation pattern with a downside breakout. I've identified it here with a few trend lines. Now first we'd take that price range tool and get the width of the move and then add it to the bottom of the breakout area. So if we got short around here at the break of the move, we'd look to take half a position off, and then the rest goes off from a trail stop. So at this point, the market fell and then made a retrace right here. So we would probably place our second stop or our trail stop down above this high and then get taken out right here. And again, it's not an absolute perfect science in the way we trail our stuff. We use a macro overlay as well to make the call, but this is just a general idea of what we're doing when we're looking at taking our profits. So the first one's always at the implied move. The second one is some sort of a trail or momentum stall. Here's another one on PAM, Pampa Energia, and we're going to look at this particular breakout consolidation. And so if we were to measure this move here, we would have a target right around here. And so that's where we look to take our first part of the position off, is right around this target. Now, if in the situation where it comes up bumping right against the target and we don't get filled and then retraces, we will take our position off even though it didn't hit that. Because again, there's a lot of asymmetry. If this thing were to fall back to our entry price, you give away all of the profits. So we look to take half off here. And then depending on how aggressively we wanted to trail it, we would either put a stop below this local low right here and get taken out as the market made a low, or we would, if we had more conviction in the trade, we might be willing to hold the second tranche all the way back to the main pullback. So a lot of the aggressiveness in the trail depends on how much conviction we have in the move. But this is just in general what we look for when we're trying to exit our trades for profits. So we get the implied move of the pattern, we have a target, we look to take off half, sometimes full at the target, and then trail the rest. So at the end of the day, there's no right or wrong way how to structure your trades. You got to do what works for you and pick a style that you like and something that fits with your psychology and emotional temperament. So some guys like to win more. They want more profits up front, and in that case, you're going to be using wider stops. You're going to be taking your profits a little bit earlier. And other guys like to have the huge wins. They don't mind having below 50% win rates or very low win rates. And in that case, you'd be using tighter stops, holding on to your winners for much longer, and trying to run them for really, really big trades. So you got to structure your trading plan ultimately around what works for you. And I hope you can use the concepts in this lecture to tweak your system and align your win rates with your emotional needs.